War is breaking out. Oil has just skyrocketed to $120 a barrel. Historically, this is the exact moment gold should be exploding to the moon. But look at the charts. Your safe haven is collapsing. Is Gareth Soloway right about a brutal breakdown to the 4,300 level? Or is the market setting the most sophisticated trap in financial history for retail investors? Don't let the red candles blind you. We are going to decode this massive paradox right now. To understand why the crowd is panicking, we need to look at exactly what technical analysis experts like Gareth Soloway are seeing on the charts right now. This isn't about headlines or feelings. It's about the cold, hard logic of price action and the patterns that have signaled market crashes for decades. Take a look at the gold chart. We've moved past what Gareth calls the euphoria phase, that moment where everyone is buying the dip, convinced that gold can only go up. But then, it happened. A sharp rejection, a breakdown candle that sliced through the trend line. What we are seeing now is a classic bear flag formation. For those who aren't chart nerds, imagine a steep drop, the flagpole, followed by a brief, weak period of sideways trading where the bulls try to catch their breath. That's the flag. The problem? Logic dictates that once that flag breaks to the downside, the next move is often as long as the flagpole itself. Gareth has already annotated the critical zones. Let's talk numbers. First, we saw a test of the 5,400 level, the high of those doji candles. Gold couldn't get through. As soon as it got rejected, the sellers didn't just step in, they pounced. This forced a breakdown to the short-term technical support at 4860. To Gareth, this is just a micro pattern, the noise of the next couple of days. But if we zoom out to the macro pattern, the picture becomes much darker. Gareth is looking at a massive reversal. He's noted that while we might see small bounces along the way, the gravity of this bigger move is pulling gold down toward the 4,400 to 4,300 range. That is a significant drop from the all-time highs. And it's not just gold. Silver is telling an even more depressing story. Gareth points out a key difference. Silver's bear flag isn't even vertical, it's flat. In the world of technical analysis, a flat flag means the buyers are even weaker. They couldn't even push the price back up to retest the previous highs like gold did. This tells us the probability of a silver crash is even higher. If silver breaks its current level, Gareth expects a flush back to $70 and eventually a devastating drop toward the $50 to $54 per ounce range. Why is this so shocking? Because it defies common sense. Right now, we have historic geopolitical instability. Oil is climbing again, inflation is sticky. By all traditional rules, gold and silver should be skyrocketing, but they aren't. And as Gareth says, when it's not going up despite all the reasons it should, that is the market telling you something very important. It's telling you that the technical breakdown is outweighing the news. It's telling you that smart money might be exiting before a larger correction. Gareth isn't just guessing, he's basing this on the retrace to the scene of the crime principle. He's looking back at the resistance levels from the 2011 high and even the 1980 high. Statistically, 80% of the time, after a major breakout, the price must return to test that former ceiling as a new floor. For gold, that floor sits way down at 3,450 to 3,500. Think about that. If Gareth's macro prediction plays out over the next 1 to 3 months, we aren't just looking at a minor dip. We are looking at a fundamental repricing of the world's oldest currency. But here is where the logic takes a twist. Gareth himself is still holding his long-term gold. He calls it an insurance policy against irrational fiscal irresponsibility and Fed manipulation. So if the expert who's calling for a crash is still holding his gold, what is the missing piece of the puzzle? To find that, we have to look beyond the lines on the chart and look at the hidden hand that is currently propping up the global economy. Because while the charts say sell, something else is happening behind the scenes that might turn this breakdown into the greatest buying opportunity of our lifetime. Which brings us to the real culprit, the silent thief that is making gold look weak while everything else is burning. We need to talk about the ghost in the machine, real yields, and the US dollar. But the charts are only the tip of the iceberg. Why has geopolitical fuel been poured into the tank yet the gold engine is stalling.
The answer lies in a metric that very few retail traders actually pay attention to: real yields. You see, in the world of big money, gold has a mortal enemy. It's not just a strong dollar, it's what that dollar can earn you versus how fast prices are rising. This is the ghost in the machine that is currently haunting every gold bug's portfolio. Let's look at the hard data. The latest reports from the Bureau of Labor Statistics, the CPI and PPI, have delivered a sobering reality check. Inflation isn't just high, it's sticky. It's refusing to go down as fast as the market hoped. And because inflation is proving to be so stubborn, the Federal Reserve has pivoted to a higher for longer policy. When the Fed keeps interest rates high while inflation remains flat or dips slightly, something happens to the math of holding gold. That math is real yields, nominal interest rate minus inflation. Think of it this way. Gold is a unique asset because it has no counterparty risk. It's nobody else's liability. But it has one major flaw. It doesn't pay you a dividend or interest. It just sits there, looking pretty. Now, if you can put your money into a U.S. Treasury bond and get a 4.5% or 5% return, and inflation is only at 3%, you are making a real profit of 2% just by holding cash. Why would a billion-dollar hedge fund manager take the risk of holding gold, which pays 0%, when they can get a guaranteed 2% real return on the dollar? This is the opportunity cost. When real yields rise, the cost of not owning interest-bearing assets becomes too high. The big players start dumping their gold paper and moving that liquidity into the safety of the dollar and bonds. This is why the charts Gareth Soloway is looking at are turning red. It's not that people don't value gold. It's that right now, the dollar is offering a better deal for their real purchasing power. This brings us to the ghost itself, the US dollar index, DXY. Since 2025, we have seen the dollar maintain a position of aggressive dominance. Despite the talk of de-dollarization and the BRICS nations, the dollar remains the world's primary liquidity sponge. When the world gets scared, when wars break out or trade tensions rise, people don't just run to gold anymore. They run to the liquidity of the dollar first. Notice the divergence. Every time the dollar strengthens because the Fed talks tough on rates, gold takes a hit. It's a seesaw. And right now, the Fed is sitting heavily on the dollar side of that seesaw. But here's the twist that should keep you watching. This high-yield environment is a double-edged sword. The Fed is keeping rates high to fight inflation, but by doing so, they are making the U.S. debt, now at catastrophic levels, almost impossible to service. They are effectively trapped. If they keep rates high to keep the dollar strong, they risk a systemic collapse of the banking system or a sovereign debt crisis. If they cut rates to save the economy, inflation will skyrocket and the real yield will crash into negative territory. And that is exactly when gold stops being a losing trade and starts being the only exit door left in the building. So, Gareth's breakdown to 4,300? It makes perfect sense if you believe the Fed can keep this real yield game going. But is the game rigged? While the Western markets are focused on these interest rate ghosts, something else is happening in the East. A massive, silent transfer of physical wealth is taking place that the paper charts are completely ignoring. To see the full picture, we have to look at the great divergence, the war between paper gold and physical gold. Because while Wall Street is selling, the world's central banks are doing something very, very different. But here is where the story takes a sharp, almost cinematic turn. While Wall Street traders are staring at their screens in a cold sweat, watching the paper gold price break down, something entirely different is happening in the physical world. We are witnessing the Great Divergence. To understand this, you have to realize that the gold price you see on your phone isn't the price of an actual gold bar. It's the price of a digital contract on the COMEX, a piece of paper that says you own gold. And right now, that paper market is in a state of controlled panic. But while the paper is being dumped, the physical is being hoarded at a rate we haven't seen in decades. According to the latest reports from the World Gold Council, central banks are not just buying gold, they are in a historic accumulation frenzy. Look at the data. China, India, and a long list of emerging markets are pulling physical bars off the market and locking them in deep vaults. Now, ask yourself the most important question in finance. Why are the smartest, most powerful insiders on the planet buying gold while the price is supposedly breaking down? If Gareth Soloway's technical analysis is correct and the price is headed to 4,300, why wouldn't the People's Bank of China just wait and buy it cheaper? The answer is as simple as it is terrifying. They don't care about the paper price anymore. They are playing a different game. They are preparing for a world where the US dollar's dominance is no longer a certainty. In the West, we treat gold like a stock, something to trade for a quick profit. In the East, they treat gold like absolute money. They're watching the same geopolitical instability we talked about earlier. The wars, the $120 oil, the fractured trade routes, and they are coming to a single conclusion. You cannot trust a digital ledger when the world is on fire. You can only trust what you can touch. This creates a massive distortion. The paper market, driven by high real yields and Fed algorithms, is pushing the price down. But the physical market is hitting a wall of supply. When you try to buy physical gold in large quantities right now, you aren't paying the spot price. You're paying a massive premium. Why? Because there isn't enough physical metal to satisfy the demand of the big players. This is the insider secret that retail investors often miss. The paper price can be manipulated, suppressed, or driven by temporary interest rate swings, but the physical reality is governed by supply and demand. If the central banks keep draining the world's supply at these discounted paper prices, eventually the paper market will simply break. Imagine a game of musical chairs. There are 100 people holding paper gold certificates, but only 5 actual gold bars in the room. As long as the music, the global economy keeps playing, everyone is happy to hold their paper. But the moment the music stops, everyone rushes for a chair.
That is when the paper price becomes irrelevant and the true value of gold is revealed. You are witnessing a transfer of wealth from the weak hands of the West to the strong hands of the East. When a retail trader in New York sees a bear flag and sells his gold ETF, a central bank in Asia is likely on the other side of that trade, happily taking the physical delivery. So when we look at Gareth's charts, we are looking at the price of the paper. It's a very accurate map of the panic on Wall Street, but it is not a map of the value of the metal. This leads us to a critical crossroads for you, the investor. If the smart money is buying the dip while the paper charts are screaming sell, who should you believe? Do you follow the lines on the screen toward 4,300, or do you follow the trail of the central bank vaults? The choice you make right now will determine your financial security for the next decade. But before you make that move, you need to understand the floor. Because even if the paper price keeps falling, it is about to hit a physical barrier that no algorithm can break, the all-in sustaining cost. Let's talk about why 4,300 might be the ultimate trap and how to position yourself for the inevitable rebound. So, we've looked at the terrifying charts, we've unmasked the ghost of the US dollar and real yields, and we've seen the massive physical accumulation by central banks. Now comes the only question that matters to your wallet. What do you do next? Is the drop to 4,300 a catastrophe that you should run away from, or is it the greatest entry point of the decade? To answer that, you first have to decide who you are in this market. Are you a trader or are you a hedger? If you are a trader, someone looking for a quick profit over the next 2 weeks, then Gareth Soloway's technical breakdown is your Bible. You don't fight the trend. If the bear flag breaks, you step aside or you short the market. But for the rest of us, the 99% who are trying to protect our life savings from sticky inflation, we need a different set of rules. We need to look at the floor. In the mining industry, there is a metric called AISC, all-in sustaining cost. This is the total cost required to dig 1 ounce of gold out of the ground, process it, and bring it to market. As of 2026, with energy prices high and labor costs rising, the global average AISC is significantly higher than it was just a few years ago. Think about the logic here. If the paper price of gold drops toward Gareth's macro targets of 3,500 or even 4,000, it starts dipping below the cost of production for many major mines. What happens then? Mines shut down. Supply vanishes, and when supply vanishes in a world where central banks are still buying, the price doesn't stay down for long. It snaps back like a rubber band. That AISC level is your physical floor, a barrier that no amount of Fed manipulation can permanently break. This leads us to the strategy for sticky inflation. We are living in an era where the dollar's purchasing power is evaporating, yet the Fed is forced to keep rates high. It's a pincer move on your wealth. If you stay 100% in cash, inflation eats you. If you go 100% into gold, Gareth's breakdown might give you a heart attack. The solution? Dollar cost averaging with a twist. Instead of trying to time the perfect bottom at 4,300, you treat gold as what Gareth calls it, an insurance policy. You don't buy a fire insurance policy only when you see smoke. You have it because the house could burn down. If the price hits 4,800, you buy a little. If Gareth is right and it flushes to 4,400, don't panic. You celebrate because you are getting insurance at a massive discount, backed by the same smart money that is currently filling the vaults in Asia. But there is one more thing you must understand about this strategy. You have to differentiate between paper gold, ETFs, and physical gold. In a true market breakdown, the gap between the screen price and the price to actually get a gold coin in your hand will widen. If you want to be a true hedger, you must own the asset that has no counterparty risk. You want the asset that Gareth says is a security blanket against irrational fiscal irresponsibility. The Fed is trapped. The debt is exploding. Geopolitics is shifting toward a multipolar world. In this environment, a temporary technical breakdown is not a reason to sell. It is a gift of time. It is a window of opportunity to position yourself before the paper market realizes there isn't enough physical metal to go around. So, are you going to let a few red candles on a screen scare you out of the only insurance policy that has lasted for 5,000 years? Or are you going to watch the smart money and realize that the breakdown is actually the setup for the greatest breakout in history? The choice is yours. But remember, the music is slowing down and there are fewer chairs in the room every single day. Now, let's bring it all together and look at the one final signal you need to watch to know when the bottom is truly in. At the end of the day, gold and silver are currently trapped in a tug-of-war between two powerful forces. On one side, we have the paper market, the algorithms, the Fed's high interest rates, and Gareth Soloway's cold technical breakdown toward 4,300. On the other, we have physical reality, the central banks, rising mining costs, and an exploding global debt that simply cannot be sustained forever. Short-term volatility is inevitable. You might see more red candles, and you might see the bear flag play out exactly as predicted. But don't let a temporary technical flush make you forget why you bought gold for the first place. This isn't just another trade, it's your fortress against a financial system that is becoming increasingly unstable. The smart money isn't looking at the 15-minute chart, they're looking at the next decade. They're using this paper breakdown to build their own security blankets, while the rest of the world is distracted by the noise. So, now I have to ask you, where do you stand? Will you choose to follow the technical charts and wait for that 4,300 level, potentially missing the boat? Or do you believe in the backing of the world's central banks and continue to accumulate your insurance policy, regardless of the short-term noise? Let me know your strategy in the comments below. I read every single one, and I'll be replying to your thoughts throughout the day. If you found value in this deep dive, don't forget to hit the like button and subscribe to stay ahead of the markets. I'll see you in the next analysis.